Hey. Good morning. Guess we should get on with it. All right, cool. So anyways, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. Let me clear my throat. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades because trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. It's good to see you. We will go through the charts today. We will look, I guess I'd like to stay technical today. I know that's difficult, but we'll stay technical. Last night in the day trading group, we were talking about how the S&P 500 has a very narrow range, but very high volatility. And that can pose, unique risks and challenges to being a trader, especially an intraday trader. And apparently, according to someone that was on Bloomberg this morning, that phenomenon of small range and high volatility is the worst since the 1980s. We haven't seen that kind of price action. 1980s, man. Holy smokes. So anyways, unique situation, and unique always adds up to risk, so be careful. So anyways, we'll take a look at gold, oil, and did you see Bitcoin? Anyways, we'll take a look at gold, oil, Bitcoin. We'll look at the stock markets. We'll look at dollar pairs and yen pairs, and really anything that you want to look at, I'll do my best to address. If you could, please click the thumbs up button, leave a comment on the recording, tell YouTube that this is quality content and that they should promote it. This is not a get rich quick channel. No, I'm not going to put you in a bunch of trades. Go, 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 trade, trade, trade. Yeah. That might be exciting, but I look at trading as a business, and what you want is consistent results over long periods of time with low volatility. Nothing sexy about that, but it is profitable. So ask questions, get involved, and I will help. In the description below the video, there's a link to my book, Strategic and Tactical Forex Trading. There's a link to my community, FX Boot Camp, which has very high quality, very intense training and live groups. You will learn how to trade properly if you become a member of FX Boot Camp. There's a link to Quant-in-a-Box, which is a macroeconomic Quant-in-a-Box. It's AI sitting on the Google Cloud that's doing macroeconomic analysis for you. Yeah, it's doing all the hard and dirty work for you. So if you're interested in automating that process, it's already been done for you. So there's a link to that, quantbox.co. There's a link to tradersway.com, a trustworthy, ethical foreign exchange broker with fast execution speeds, narrow spreads, huge swaps, world-class customer service, and above average good-looking people. Sounds like I'm being facetious, but the honest truth is they earned my loyalty and respect, and because of that, I recommend them to you. Tradersway.com, all those links are in the description below. Go check them out. Starting with, should we do gold or should we do Bitcoin? Bitcoin's got the amazing little pop. Where's my Bitcoin? Do I have Bitcoin over here? Oh, I guess here. And I'll zoom in a little bit. Look at this. Okay, look at this. We get down on Biddy. We get down to the lower bound. Okay, remember that's the projected low that we've had for the month of May. Okay, you've known that for about 3 weeks. Okay, and we get down to the projected low and pop goes the weasel. The weasel. Remember the weasel? Anyways, a big move, huh? Big move. Let me move some things around here on my other desktop. Hang on. Move that over there, move that there. Cool. All right, so you see, like, once again, reaffirm in your psyche that you have the right tools. Okay, here's a May front run that presented itself. Here's a May entry. Here's a May entry. And based on all these projected tops or potential entries, they all say the same thing. This is the projected low. Cool. Grace says, Wayne, I've done a dozen BTC trades, but you don't seem to stay in them more in a day or two. Okay. That might be the right strategy, Grace. Boo, 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 boo. You'd like to go a week or two. Well, it's probably, so like, I'm going to promote FX Bootcamp here. If you take the day trading course and the swing trading course, one of the things you learn is when to set your trades up. What hours of the day, what days of the week, when in the month do you set up a position trade? And my guess is you're probably doing good trades, but sort of like kind of at the wrong time. So that's what I would work on. So for example, if you were trading in here, you would have been short a couple of weeks. Okay, and there's your profit target, so you would have been done. But maybe you're trading in here. And so that's the lower low, lower high you set up, and that's great. But the downtrend for the month of May is technically, well, I wouldn't say over, but we've hit the conservative target, and you shouldn't expect much more, which might be the end of your longer term trade. But there's still a pretty decent inkling of this is possible, okay, at some point. So if you enter in the middle of the month, it's hard to stay in a trade for a couple of weeks. Okay. Now, when I plan, I'm planning daily, weekly, monthly, and quarterly. So, so again, Grace, the trick is entering at the right time for that particular strategy. For a potential quarterly strategy, you might be shorting the first week of January and holding to April. But if you're starting in the middle of March and you're still doing that trade versus setting up the next one, okay. Anyways. Anyway, so Bitcoin long-term up, short-term short. And if you're a bull, you're probably going to look for some up. Okay. A bull is probably going to look at it this way for June. What do you think? That's what a bull is thinking, right? What would a bear do in this scenario? Because that might not fully work out. Well, it could partially work out. I think a bear is thinking this, but I think a bear could also tolerate that. Okay, they're either going to sell the lower high, top of the range to you, or they're going to trade a double top. What do you think? Smell like a plan? Which one's right? Well, they're both right. Well, all three of these are right. We just don't know which one's going to happen. Yeah, Grace, and that would be a few weeks. So going back to that, let's say you're a bear on this, Grace, and you find yourself here on the 10th of June. Okay? If it rolls over, and because you're a bear, you sell it, you could sell it for a day or two, or you could stay short July, August, and going into September. So I'd say if this double top held and you're already a bear, you may decide to jam your stop and take a walk. If you get that first trade set up and a day or two goes by and you say, well, I'm always exiting trades after a day or two. I wonder if I can stay short until the third week of August. Well, that's a psychological decision. Managing it doesn't get any more difficult. You jam a stop at break even. Okay? So I'll give you an example. Let me open up a different account. Okay, I'm in a hedged position. Okay, and oh, microphone's in the way. Here it is. It's there. Anyways, I'm in a hedged position that I opened February 13th. At 5:46 a.m. Okay. My point here, Grace, is I don't have to do anything every day. The work I did was way back on February 13th. Okay, done. So now I have to actively not do anything every single day. Okay. Cool. Okay. I'm short USD Mexican peso, one standard lot, and $6,000 profit. And every day I collect interest. Ooh, let me open it back up. So since February, I've collected in swap $999.36. Huh? $999.36 in swap. Swap, just the swap. Cool. And I actively do nothing every day, Grace. So you have to have the intent. And once you've entered the trade, it's psychological after that. You jam your stop at break even. Okay, you set it and forget it. So we can take a look at that. So that trade, I'm short 18,68830. 18, what was it? 68830. 68830 is my entry. And back out. There you go. Took the 5A cross, Bubba. Bubba! How you do that? Oh, I shorted here. Okay. And now I do nothing every day. Okay. So at that point, it's the psychological aspect that, Grace, that you have to integrate in there and say, you want it to be short. Now, one of the things I talked about in the day trading group at that time was my target, okay, was 8. And you're like, what do you mean 8? 8. You're like, what do you mean 8? We're at 18, almost 19. 8. You're like, that's inconceivable. What do you mean 8? It can't be 8. It'll take 10 years to get to 8. Yeah, I'll have to actively not do anything every single day. Okay. Frank's been short for over a year. Yeah. Cool. Okay. Anywho. Gotta love that peso. Look at the bottom, just tickling that bottom, huh? Tickling the bottom. Now, I'm hedged that position, so I'm also short euro dollar. So, and you're like, what do you mean hedged? So, I'm short dollar versus peso, but I'm long dollar versus euro. Now, at the time, euro was basically free, right? So I'm borrowing euro for free, converting that into dollars, then taking those dollars and converting that into peso. Now you're like, Wayne, why not just trade euro peso? And I say, shut up! So anyway, I'm hedged. So that trade is losing money, obviously, because it's hedged. But the other one, the peso is making money. And combined, there's a $5,000 profit. Rand, I'm staying away. All right, so let's go back. Let's take a look, see what's happening. All right. Dollar was strong and then has kind of petered out, but I think we're waiting for today's trading days. I don't see a reason to own Rand, do you? Darko says, Wayne, I was just thinking how taking profit after earnings season over in the stock market is affecting Forex pairs. Well, I suppose we'll talk about that next. I guess we can go back there. Might as well do it now. Nothing is happening, and unless you're on a 15-minute chart. So I think a lot of people, a lot of Forex traders in particular, are inside of these candles. These are daily candles, and you're catching these moves, but there's no follow through. And we're stretching to figure out what's going on. And the real answer is there isn't actually anything going on. So for example, if you earn 4.5% in the money market, why would you invest in the stock market, assuming you already bought in October, November, and December, and January, and February, and March, and April? Now we're in May. Somewhere along the road, man, you've already stopped and loaded up on what you wanted to buy. So now what? Now you're faced with a different choice. You could do nothing and earn 4.5% on your cash, or you could buy more of the stock market. Well, taking very little risk pays you 4.5%. So taking bigger risk is you're going to have to be compensated for it. So let's say you would only buy the stock market if you believe the stock market would go up 10% versus the 5% doing nothing. Well, that means the S&P 500 is going to go to 4,600 if you're going to take that risk and be compensated for taking the risk. All right, so let's take a look at that. 4,600 would be about here. So what do you think about that? And you're like, dude, that's a big ask, isn't it? That's a big ask, isn't it? Like, oh my God, just to get compensated for the risk you took. I mean, you might look at it and you're like, well, you made 10%. What's the big deal? No, risk-adjusted performance tells you that's basically break even. Otherwise, if you only made half of that, they're like, dude, the amount of risk you took to make that little bit of money makes you a bad money manager. So just to kind of get to break even, you're like, there's there. And to have any alpha on this, you'd have to be above that. And you're like, dude, what? So you're thinking like, well, you know what? Maybe I'll just sit on cash and it could do this for a while. And you're like, I'm going to skip that volatility and I'm just going to earn the 4.5 with no volatility. And I think a lot of people are kind of just thinking that way. And Darko's like, yeah. And so after a nice little run, you take some profit. You don't need to rebalance yet, Darko. So the rebalance is going to happen in a month. So that idea of like exiting and rebalancing, that's going to be this time next month. But what I'm saying is money managers are asking, do you deploy more capital and start overweighting? Like you have that much conviction to overweight? And if you're not sure, you're like, you know what? I'm just going to pick up, I'm going to just stay a little bit conservative. Okay? Think of the logic here. You're like, I'm going to stay a little bit conservative. You're already long the stock market. And you're worried about the next Fed meeting. You're worried about a potential recession. You're worried about the debt limit. But you're worried. So you say, well, I'm going to keep 20% cash. And pop that into a money market and earn 4.5. Just in case we start to go into recession. You see the logic there? So now they're like, even if they think there's upside, they're already in the trade. Adding more is difficult. And maybe, imprudent. Is that the word? Unprudent? Imprudent? May not be prudent. Okay. Darko says that's good profit management. Yes. And that's my point. We forget that this is how institutional investors think. And so you might deploy your capital differently is all I'm saying than loading the boat. Meanwhile, retail traders get stuck on a 15-minute chart and get caught in volatility like this, and you get destroyed. That's difficult. That's tough trading in there. Okay. So I've been spending a lot of time on portfolio construction. And maybe I was thinking, maybe that should be a summer school one day. But nonetheless, I've been able to create a portfolio that is diversified. It's actually more diversified than the S&P 500. There are hundreds and hundreds and hundreds of stocks in the portfolio and in all the sectors. But 40% less volatility than the S&P 500. 40% less volatility than the broad index. Oh, is that right, Jim? That's killer. That's so killer. It's still not enough, Jim. But anyways. So 40% less volatility than the broad market. And yet my portfolio makes significantly more money. Oh, God. Oh, God. But you have to think institutional to get there. Okay. Yeah, Jim says there's swaps, but the issue, Jim, is it's not enough. It's not enough to cover inflation. Oh, please, Thato, just call me Your Highness. Oh, please. Yeah. Yeah, but you're just saying, yeah, it is pretty crazy. It's pretty funny. Shows you that nobody wants to lend them money. Morning, Richard. Okay. So, what are your thoughts on euro dollar? Well, to discuss the answer to that, Thomas, you have to tell me what are your thoughts on S&P 500. That's why we're looking at this. Yeah, Jim, see, it shows you that it's not enough. And then when you throw in default risk, they need to pay about 150%. And by the way, if someone ever says to you they want to borrow money and they'll pay you twice as much back, they don't have any intention to pay you anything back. They don't have any money. They're going to borrow money from you to pay someone else's debt. It's called a Ponzi scheme. Yeah, thinking about how bad it is for the people there. Yeah, and I have some Argentine friends too, but maybe the best way of thinking of it, Jim, in maybe a more positive light, the people of Argentina would really love for you to come visit. Why don't you bring some hard currency like US dollars, stay in the hotels, eat in the restaurants, tour around, get a tour guide, that kind of stuff, put some hard currency into their economy. They would love the visit. All right, so Thomas, are you writing your answer? Tell me about the S&P 500, up, down, or sideways? Thank you, Ojo. Hello? So weird to ask a question and then not listen to the answer, huh? All right. Yeah. Hello? Yeah. Okay. Well, anybody else? What do you think? Stock market up, down, or sideways? You know what? Let's just do a poll. Hang on. And I will say this week, what will the S&P500 do this week? Question mark. Up, sideways, down. Okay, couldn't be easier. Yeah. Yeah, Lucas, yeah. All right, now this is anonymous, so you can go ahead and answer. Don't try to think about like, what did Wayne teach? No, just answer like it's an opinion piece. How should I know? We call that fundamental and technical analysis. Boom shakalaka. Or is it shakalaka boom boom? How should I know? You've done research and analysis. That is your job. Denise says Empire State down. Yeah, for sure. Oh, while you're answering that, let me bring up another interesting observation I've made recently. One of the things we've been talking about is core inflation, super core inflation. And in discussing that, we talk about like supply chains being fixed. So suddenly if you need to buy an aluminum garage door, you don't have to wait 6 months and the price is back down to basically normal. And you're like, okay, good. So aluminum doors are back to normal prices. Okay, great, cool. But then there are other things like rent and wages that are not back to normal. And we call those, that's sticky inflation. And the example I say is, imagine supercuts used to be $10 and now it's $12. And I said, so when is it that, when will supercuts drop the price back down to $10? Do you guys remember this? We've had this discussion many times. What's the answer to that? If supercuts had to increase the cost of a haircut by 20%, when do they cut it back down to the old price? When do they go back to the old price? Anybody? And the answer, of course, is yeah, they don't. You know what, right? You know what's happened? I drove past the local supercuts and went out of business. It went out of business. It's gone. Because my guess as an economist is that there was a supply-demand imbalance. The people that work there need to earn high wages because we have persistent inflation. I would argue food is still expensive. Rent is still expensive. So they have to charge 20% more than they used to. That's big, especially when the Fed says inflation's only 5%. Well, it's supercuts, let's say. I don't know anything. I'm just grabbing at numbers. I don't know what they actually charged. But let's say they raised by 20% because they face a different inflation than what the Fed reports. Okay? And then the consumer says, I can't afford to go to supercuts because prices are way up. And as a consumer, you also have your own inflation. And so you're like, well, with food and this and that and the other thing, well, you can't get cheaper than super cuts unless you're doing Floby, COVID cuts. So what you decided to do is, well, instead of getting a haircut every 4 weeks, you get a haircut every 7 weeks. And now that doesn't add up to the wages that the haircutters need. What do you call them? Stylists. Now the hairstylist, they might charge, let's say $12 instead of $10, but here's the problem. Less people pay the $12 and it doesn't add up. Now, of course, they could have just kept it at 10 and had higher demand, but whatever. So anyways, I never even saw that one coming, by the way. In our conversation, I'm like, when does Supercuts cut their price? And we all said never. I never dreamt that that would end up with all the hairdressers losing their jobs. But it's happened. And I'm like, ooh, that's an interesting observation relative to what we're trying to see and trade in the economy. I'm like, those people lost their jobs. NFP. You see? Very interesting, huh? I'm like, wow, dude. Okay. All right. So you answered the S&P 500 will be sideways this week. So euro dollar will be sideways. And for Thomas, who came in, asked a question and then left, poo-poo on you. What's the point, Thomas? Anyways. So instead of just telling you my opinion, we answered the question. You can see the skew is to the downside. So if we were to use this analysis and I were to go to euro dollar, I would say sideways to down, and that translates to this. And that's actually last night's trade plan from the day trading group. Yep. So day traders may already be in this. Just saying. I'm not saying, I'm just saying. Look, I'm not saying, but I'm just saying. So anyways, guys, if we start to see like people losing their jobs because of persistently high inflation, we have something, there's a storm brewing. And this whole time we've been talking about it. I don't want you to just sit here and observe. This is near target. This is exactly target. This is double top on target. This is bearish M3 on our way to bearish M1. This is showing a different world. This is risk on. This is risk off. Up in here, how did I use this information? You can go back and watch the videos. I'm telling you, day in and day out, up in that zone, that I'm rebalancing my portfolio to address downside risk. And I did. And so far, it says, Wayne, good job. You did the right thing at the right time. But very often, traders sit here and they just watch this fall, and they don't understand that something has changed. Okay? Now, Frank says euro dollar could be down and S&P 500 sideways. Well, again, if you look at the results of our poll, okay, sideways with downside skew. Okay. Now, Richard says sold at M2. That's not how I recommend you trade. Just so you know, never once in the last 20 years have I said sell at M2. Just, again, I'm not saying, I'm just saying. May you ask a stupid question? Do I have the option to not answer it? Okay. But go ahead. Yeah, for sure, said the sheep. For sure, said the sheep. All right, here we go. Inside the range. Bum, 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 bum. Okay. Let's see. Bottom of the range. Top of the range. We're in the middle of the range. But if you're aiming for the bottom, then you are selling here. And your target is bottom of the range. I don't sell M2. That is correct. Never once have I suggested sell at M2. Where do I sell? Okay, is it realistic to start trading and make money for someone without financial background? Sure. Not millions, but maybe a bit more than minimum wage. Sure. Well, Jim, he's a bear, so buying at M2 wouldn't be an option. So what is the correct price for starting a downward move? If you were a bear, no, wrong. Richard, you either need to redo the training course or you're not a member of FX Bootcamp and then you have no idea what you're talking about. But you're either forgotten or you just don't know. But oh my God, no. So you don't need a background of finance, but you'll need a track record. Okay? If you're going to trade opium. Isaac says short to 200 EMA. No, I've never recommended that either. Isaac, in my book, which is probably, 15 years old now, I say the 200 EMA is a target, but not an entry. Okay? So anyways, so no disrespect, Richard, but you've either forgotten or you don't know. $88 cures you. It's a pittance. Yeah. What does a track record mean? Trade profitably with low volatility and consistent results for 5 years straight. You're on TD Ameritrade instead of MT5? Yeah. But you don't know how to trade pivot points. you're using some tool and you have no, like, your answers to, and I don't mean this disrespectfully, so please don't take it wrong, but you're grasping at straws and doing stuff that doesn't make any sense. Like, I didn't recommend any of that, so I don't know what you're doing. So, you have to go back and redo the swing trading and day trading courses, because I don't know what the heck you're doing on pivot points. I've never traded that way. So I know it's not in the training course. Okay. So anyways, that's all. Refocus, right? So again, no disrespect. Don't get upset. Don't get mad. All that kind of stuff. Just go back. That's it. I would call that a successful moment where we just found a gaping hole. Good. Let's fix it. Something to focus on. Okay, you're using the tool incorrectly. So let's work on that. That's something to work on. Okay. Shakalaka Boom Boom says, yeah, lower the price so there's more demand. That's what supercuts, I guess, from an economics point of view, needed to do. And I guess it was too late. But yeah, that's what happened. Was there was a supply-demand imbalance where people at supercuts needed to make more money because there was inflation. But because there was inflation, customers couldn't afford to pay the higher price. Awesome, Richard. Thank you for taking it well. I appreciate that. Roderick says trading takes time and will not happen overnight. Oh yeah, well the question was, do you need a background in finance? No. Now, if you change the question, I suppose, if you go to someone with money, so they're smart enough that they've made money, and you say, I don't have a background in finance, so I can't prove I know what I'm talking about, but nor have I actually traded, so I can't prove I'm a good trader. So give me some money? No. It makes no logical sense. But if you said, look, I don't have a background in finance, but I've been trading successfully for 5 years, and if you look at my trading history, not only am I profitable, but the returns are quite consistent and the volatility is quite low. And they're like, ooh, that's really impressive. Yeah. They'll ask you, do you have a background in finance or economics? You're like, no, not officially. That's not quite right. Not, no, you're like, no, you're not a trained what official? I got the wrong word in my head, but you're like, I don't have an official background or traditional background, I guess, economics degree, but I study economics and I use it all day, every day. Like I'm self-taught. I'm a self-taught economist. And I am a self-taught economist. Okay? So do you need it? No. But down the line, why not? Why not get it? Right? So that's what I did in my life, where at one point I said, well, I'm a self-taught economist. I use macroeconomics in my trading all the time. But now I just say, well, I have a macroeconomics degree from Harvard. And people are like, fudge. Fudge! That is amazing. I'm like, cool, right on. And it just plugs a hole, right? It's a check mark. So imagine somebody asking questions, right? Do you have this? Yep. Check. Do you have that? Yep. Check. And you just check off all the boxes, and all of a sudden, right, you get back to the basics of, well, what can you do for me? Right? Richard says, I'm just studying technical analysis, CMT, and you're trying different methods, and you're going to be more consistent. Yeah, but the trying different methods, be careful. You need to do one thing, Richard. Let's say it has nothing to do with what I teach. Find something else. Whatever it is. Let's say you're an Elliott wave technician. Great. I don't teach Elliott wave. I have nothing against it. I can see that it probably works. It's price action with some Fibonacci in there. Great, great, great. It all works. Great. So it's a technique. Great. Now, deploy or employ that technique beautifully and consistently every single day. You will be successful. So when you say you're trying different methods, whoa, 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 whoa. Either trade exactly the way I teach you, or don't trade at all like it. Your consistency will still be important. So patience and discipline and consistency is, right? So like, for example, one of the concepts I do teach is like flip a coin, and it'll tell you whether you should be a bull or a bear over the next 3 months. Or maybe even over the next year. Flip a coin. And you flip it, and it says, you can only buy the United States dollar. You can never sell it. You can only buy it. And you don't even know if that's risk on or risk off. It doesn't even matter. Anyone can see. Okay? So you're like, okay, I only buy the dollar. So then you look at these pairs, you're like, okay, so if I can only buy the dollar, I can only sell Aussie dollar, I can only buy USD CAD, I can only sell Euro dollar, I can only sell pound dollar, I can only sell Kiwi dollar. Okay, great, fine. And so now you're like, can I sell this now? And you're like, yeah, actually, yeah, you're pretty close. I would suspect over the next couple of hours that you might have an opportunity to sell somewhere in here. Cool. So now you drop into a small time frame and you wait. Do you sell that? Nope. And so now you just wait, and you're super patient, you're super disciplined, you're super consistent. You can only sell this pair. Under no circumstance can you buy it. So we don't know your fundamental rationale for that. In this case, you flipped a coin. But you're so hardcore disciplined that you're not even thinking about all the other things you could be doing. But wait, I could just be buying this now and getting filthy, stinking rich. Look, right? If you're like a dog chasing its tail, you will never be, right? Like if you're just running around looking for trades, you're not going to be consistent. And you clearly are not patient, right? And I'm not saying you, I'm saying somebody in that scenario. So what you need to do is break all those molds and wait for this to be bearish. Now, do I care what moving averages you use? No. Do I care what technique do you use? Like, you're an Elliott wave technician. Great. An Elliott wave person wouldn't sell this. Should you use an oscillator? Yeah, sure. If that helps you make the decision. Well, Wayne, what should I use? Stochastics, MACD, CCI, RSI, combinations of these? Whatever, bro. I don't care. It doesn't even matter. That's why you don't want to start trying 5 or 6 or 7 different things, Richard. No. Find the one thing and be incredibly good at that, because right now, based on my hardcore discipline and my analysis of the market, Now we know the truth of it. My analysis is flipping a coin. It doesn't matter. I sit here and I wait, and every tick I say, sell now? No. Sell now? No. Sell now? No. Sell now? No. So when will I know when to sell? I could wait for a 5A cross down. I could wait for a 21.55 cross down. Okay? I could wait for a 21.55 cross down on a 5-minute chart. A 5-minute chart! No, I can't wait that long. Well, then you're not disciplined, nor are you patient. Okay? Do I think low volatility is good for the markets? It's not good, it's not bad. What I discussed last night in the day trading group is the most dangerous thing is if the market's sideways and you're frustrated because you're not making a ton of money, then you're psychologically not in the right place. And so I pointed it out. I'm like, let's look at what is happening in the broad market. Nothing for 6 weeks. And you think you should be making big money. Why do you think that way? And so in risk-adjusted performance analysis, what you're trying to do is look at the beta, which is the market, relative to your alpha, which is your performance to beat the market. But if the market's not doing anything, why do you think you should be making big money? And when institutional investors send out their due diligence teams, they look at these things. They compare alpha versus beta. And statistically speaking, the only way you can beat the beta when the beta ain't doing anything is for you to take additional risk. So let's say euro dollar hasn't done a lot over the last 6 weeks relative to normal ranges and stuff, but you've done very, very, very well. Well, you might have overtraded, or your lot sizes might have been too big. So like, let's say the euro dollar only moved, 3% over the last 2 months, but you're killing it. You're making 20%. You're like, dude, too much, maybe, right? And so what you're doing is you're making money off the risk side. And you have to remember, investors and in particular due diligence teams working on behalf of potential investors, they're trying to reduce risk. And they might say, all right, this person's crushing it, making 20% when the markets aren't doing anything, but we're not interested in that kind of performance. Okay? So anyways, going back to this, I don't care if you use let's say, what should we do? Forgotten like some of this crap. What is some of this crap? I guess I got to delete a bunch of this. Where's just my normal standard stuff? It looks like has there been an update? Some of my stuff's gone. Well, some of my stuff's gone. So we'll go over here and we'll do it this way. Standard. We'll go standard. So this is the classic template. Cool. Wayne, should I use MACD here? Yeah, you could. Should I use stochastics here? Yeah, you could. Yep. Okay. The thing is, if you already know that you want to sell, then it's so much easier to now simply wait for your technical entry. Which one do you use? The one that you like, the one that performs well for you. Are you trading MACD or stochastics on this case? Well, one is price, one is market. Are you using the moving averages? Yeah, that's good too. Are you simply using price action and no moving averages or very few? Are you using something that looks very bare bones like this? Cool. Great. Is that bearish? No. So at some point it probably will become bearish. So I really don't care about the tools and techniques, but do one very, very, very well. And even if your whole strategy is flip a coin, and now all you wait for is bearishness. Okay, so let's draw it like this, and let's say this moving average rolls over. Cool. You only sell in a falling market, and you only sell high. Okay, you only sell high at resistance in a falling market. And that's all you do over and over and over and over and over and over again. Is it Elliott wave? No, not really. Is this template like the classic FX bootcamp template? No. Could you add a stochastics? Sure. Could you change this moving average? Yeah. It doesn't matter. None of it matters. It's all illusion. The longer you hang on to like the mechanical way of thinking, like my MACD will tell me to sell. No, it won't. You have to understand the math of what MACD is doing. It's just another piece of the analysis. The most important indicator you have is the gray matter between your ears. So you made a decision here somehow, some way. You made a decision. You made a decision. You made a decision. You're not looking at this asking for the chart to make a decision for you. No. No. So again, don't look for trying 5 or 6 different methods. That's what scared me in the comment. Dude, why don't you just do what I teach you? Is it perfect? Is it the best? No, and no. No, it's not. No, it's not. It's good enough. If you execute, you will perform. Okay? Okay? Cool. So, if it starts doing this later today, I will successfully trade using nothing but price action and one pivot point. We call this scalping. Cool. What's the secret to successfully scalping? Knowing that this is where the market is likely to turn bearish. That's it. How do you know that? Well, that's your job. Okay? Setting up an ambush and waiting. Your job is to take the high ground. Okay? You don't need any indicators, Richard. None. So what you should do is start with price action. How do you understand the way that the market moves? And then from there, you use these other things, indicators like a moving average or an oscillator, to help you measure the price action. You see? So I'm looking at price action here. It's still up. It's still bullish. Great. A moving average line, which I have there, smooths it all out. So we're above the moving average. Are we bullish or bearish? We're bullish. We haven't made a lower low. Is it bearish? No, we haven't made a lower low. We're consolidating way up at a psychological level like this 125. We're consolidating and it's failing to make higher highs. Is that relevant? Oh, yeah. Bulls are taking profit. How do I know? I looked at this at a higher time frame, analyzed it, and said, we're at resistance. Now, if I happen to be fundamentally bearish and I said, well, I think the stock market's going to fall today and I think the dollar's going to get strong, sweet. Then I'm thinking down anyways. So I'm waiting for a reversal up here because I think this is where bulls are going to take profit and get out. And the market will fall. And this will technically turn bearish. Well, how will I know it's bearish? Well, how about a lower low, lower high? I know those don't exist in an uptrend. Or how about a breach of the moving average as support? Oh, yeah. Well, then we would be below. And I'm just talking about a filthy, stinking, no good 5-minute chart. Who cares? This is a worthless chart. It's only tactics. It's only tactics. Think of it. Kicking down doors doesn't win a war. Okay? But you have to know how to do it. Kind of need a strategy too, right? Okay? So I want you to think this way. One of the things that the swing trading group is doing, well, I've invited them to do it. They can do whatever they want, but I suggested and highly recommended that they plan the entire month of June. Now, they're days, if not weeks, away from a potential entry on that, but they're supposed to think about, well, let's say the potential high and the potential low and where they would start buying or where they would start selling and organize the whole thing and be able to write it down in a coherent trade plan. It's interesting, right? And it should be a straightforward matter. Imagine I told you 3, 4, 5, 6, 7, 8, 9, 10 days ago that I'm a bear on pound dollar, and around 125, I'm going to look to sell. So what do you think I would be doing now? Trying to figure it out? Asking my MACD what to do? No, I told you 6 days ago, I'm going to look to sell, not sell, look to sell, pound dollar at 125. Why? And I can just bust out 5, 6, 7, 8 different reasons. Let's say there's a massive pivot point there. Great. Massive psychological level. Great. Timed all around Fed meetings and changes in market sentiment. Great, 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 great. Blah, 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 blah. The thing is, I'm sitting here with intent. I know exactly what I want to do and exactly why I want to do it, and I will carry it out with great vengeance and furious anger. I will destroy the pound dollar, take it down. And I'll probably be successful at it because of that focus and intent. And if it never does it, I never get my entry. Okay? JP says, hey, I get confused on the rules. Don't sell at M2. Well, that isn't actually a rule. I've never recommended selling at M2. I didn't say you can't. Like this idea like, oh, I'm short at M2. What? No, you sell at M3. Like it's very clear in the training course. This is a buying pivot in an uptrend. This is a selling pivot in a downtrend. Where people get mixed up is they don't know if it's an uptrend or a downtrend. They're just like, I'm supposed to buy at M2. I'm supposed to sell at M3. No, you're not. You're supposed to tell me, is this an uptrend or a downtrend? Are you a bull or a bear? I don't know. My pivot points are going to tell me because pivot points are awesome. Wayne tells me every day pivot points are awesome. They're tools. Okay? When you drive a car, you have a steering wheel, you have a gas pedal, right? A throttle, and you have a brake. They don't drive the car for you, unless it's a Tesla, right? But even then, these are just tools. Are you a bull? Yes. All right. Buy the dip. Well, how do I measure a dip? Well, you can use price action. You can use moving averages. You can use Fibonacci. You can use pivot points. But if you don't know you're a bull, it will never happen, right? And so in that case, JP, it's more like you buy a dip in an uptrend. And so if you're using pivot points, well, that's the space between the M2 and the central pivot. Where people go wrong is they buy in that same price in a downtrend. Well, once again, I've never recommended that in a downtrend. I recommend that in an uptrend. Why? Bulls only buy dips. Bulls only buy dips. Okay? Up, 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 down, down, buy. 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 Up, 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 and okay. As soon as you get down, 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 up, up, well, that's where bears come in. They only sell rallies. Sell. Down, 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 up, up, sell. Down, 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 up, up, sell. Down, 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 up, up, sell. Okay. Okay. Yes, Jim. So in that case, we call that a day trade. Okay. So let's change that to a day trading template. Okay. Daily confluence bearish, or let's just, I don't want to do that one. Day trading bearish. Okay, this is very simple version. Okay, okay, we're above the selling, we're above the sell zone right now. And you'll notice even on a 5-minute chart, there's no bearish signal. So Jim, you can sit here all day, JP, and wait for the 2155 cross down. So that would end up looking like this. Okay. Down to the 55, double top, down to the 200, then probably lower high, and then probably lower low. Okay. At that point, okay, you can engage. Because at that point, your 2155 will cross. Okay, oops. You'll get something like this. Okay, I'll get rid of that. Okay. And in particular, when you get lower than this low, okay, so now you're down here, you definitely can start selling lower highs. Now, it's not perfect because we did go above this zone, so you have to keep your spidey senses tingling, right? keep your wits about you. But you would sit here, JP, if you are a bear, you need to be a hardcore disciplined bear. And right now you're sitting here and you're waiting. Sell now? No, it's a higher high, higher low. Sell now? No, it's a higher high, higher low. Sell now? No, it's a higher high, higher low. Sell no now? No, it's a higher high, higher low. Sell now? Yes, it's a lower low. So now you can start thinking about selling in here. So your new plan would be sell the lower high. And you probably waited for the 2155 cross, so you're thinking bup, 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 bup. Okay? What most people do is they just sell here because they say, well, Wayne's training course is that's the sell zone. Okay, but there's no trigger. Where's your trigger? The market's bullish. Okay, do bulls sell high? No. Do bears sell high? No. So what you need is bulls to take profit. And bears will later engage, probably lower highs. Why? Think of it this way. Bulls only buy dips in an uptrend. Bears only sell rallies in a downtrend. So the first move is never, right? Here's where bulls buy. They never buy anything else. Bears only sell here and nothing else. So if this reverses, what's going on here if it reverses? That's bulls taking profit. Nobody's selling. Bears don't sell higher highs. Bears never, ever sell highs. A bat sells a high. A broke-ass trader. Okay? Bulls exit at resistance. At the highest high they could possibly get. That's when a bull exits. So now your job as a bear, if you said you are a bear, and how did you become a bear? As simple as flipping a coin. Or maybe you actually did technical and fundamental analysis. Nonetheless, you're a bear, so you only sell lower highs, and that's when you engage. So your job, JP, would be to sit here for hours and hours and hours and hours until you observe the lower low, lower high. Okay? Richard says analysts have a buy going to 130. I don't follow anybody. Okay? I have no idea what other people think. And this might come across arrogant. I'm not trying to, that's not the message I'm delivering. So you can interpret it any way you want. But I don't give a damn what other people think. The more I analyze what, market conditions, the more I understand that other people have no idea what they're doing, or they're making mistakes, or they're doing weak analysis, or they're misinterpreting the data. There's so many things going on in this market that why would I even care? So it's more like I need to know exactly what I want to do and what I intend to do with clarity. Because if I'm wrong, let's say I want to sell this and I'm wrong, I will sit here all day and not get an entry. So what? Okay? Richard's like, no, analysts at the big banks. The big banks are some of the worst freaking traders, Richard, ever. Are you joking? Oh my God. They're bankers. Right? They make 150 grand a year, 200 grand a year to sit at someone else's at a desk in some building somewhere, trading other people's money. What, they're smart? They don't even care. Okay? Now, also, well, I'll just leave it at that. Like, dude, I couldn't care less. And I used to pay for a service, in fact, that would show me bank positions, and I can tell you, banks suck. What they do is they offload their risk to hedge fund managers that do have an opinion. But here's the thing. I also know for a fact when they offload their risk to hedge funds, they pick hedge funds based on the hedge fund's intent. So a hedge fund will come in and they're like, we're going to take pound dollar down. They're like, cool. And then they let them do it. They might also take some of the money and give it to another hedge fund that says, we're going to push the pound dollar up. They're like, cool. And now the bank is neutral. But here's the thing. You're not trying to be the bank. You're trying to be the trader. And if you walk around like, I don't know what's going on, I'm not sure if I want to be a bull or a bear here, then you're not acting as the bank, nor are you acting as the trader. So you got to pick a team. Banks are trying to offset risk. Okay? Okay? But okay, so now you're talking about what? Economic strategists? That's fine. Now remember, if you get 8 economists in the room, you're going to get 10 different opinions. So if you're going to read economic analysis, that's different. That's not bank positioning. So if you're going to do that, that's good, and organize them. And you might say, well, these 2 or 3 bankers or economists are a little more hawkish. These ones are a little more dovish. These ones are in between. And you organize them and you look at how, the information they're coming up with. And you pay attention where this one might say, see, look at the real estate market. And then another one will say, look at the commercial real estate market. And you're like, okay. And then look at these core inflation levels. And then someone else says, look at credit contraction, and you're writing all these things down and adding them up into your own economic outlook. You're like, okay, the Fed is pausing probably, but there is continued economic, or I should say credit expansion. So M1 is falling, and that will slow the economy down, push us toward more of a risk-off scenario. Lowering volatility, but also putting downward pressure on asset prices. Then you look at Quant-in-a-Box and you say, well, that makes sense because seasonality would dictate from July, June, July, August, that would naturally occur anyways. So if the boat is loading to the starboard, it's going to probably lean that way, And so you're like, okay, so maybe under those circumstances with these economic, rationale backed up by these types of studies, backed up by seasonality, you're leaning toward more of a risk off. So neutral to risk off scenario. Now, in that case, you'd probably be, buying dollar, but now you have to analyze how's Europe doing, how's Great Britain doing, how's Canada doing, how's New Zealand doing, how's Australia doing, how's Japan doing. So if you're going to be buying dollar, what do you want to be selling? What are you more aggressively going to sell? Are you more aggressive on selling Kiwi versus CAD versus pound versus Aussie? And you start organizing in order that you might say, I want to sell Kiwi first, I want to sell Aussie second, I want to sell Pound third, I want to sell Euro fourth, I want to sell CAD fifth, I want to sell Yen sixth, right? And you go in this fashion, and now you have clarity, you have intent, you have strategy, and you have focused tactics. Or you just burn through a bunch of charts and you try to figure the shit out as you go. Not going to work. Okay. Okay. But I'll tell you, no one will put more thought into your trading than you. And so, yeah, reading analyst reports, I guess here's what I would do if I were going to use that strategy. Okay. Now I'm not going to contradict myself. I just want you to listen carefully to my intent here. I would not read 5 or 6 or 7 or 8 different bank reports. I would not read 5 or 6 or 7 or 8 economic reports from economists at big banks and hedge funds or wherever your sources you're using. Okay? Read a bunch and then pick the analyst or pick the economist that you like best. You like the way they write, or you like their point of view, and then just use that one. Because I said flip a coin and you'll be successful. Or, right? Well, listen to one analyst, one, and do exactly what they say. But if you do 7, you'll get 9 opinions. So now, once again, you're all over the map. Well, those individuals, those human beings, they're human beings. Whether they're analysts or economists, they're humans. They go to work every day. They look at the data and they make an opinion. Well, why can't you do that for yourself? For crying out loud. You're going to let someone else dictate your life? Even worse, some idiot on YouTube, you're going to listen to them? At least to work at a bank, you probably have to have a college degree in economics, probably a master's or PhD in economics to have the job. Why? Because banks hire qualified people. You don't need any qualification to be on YouTube. You can be a complete moron and be on YouTube. So, dude, don't listen to a YouTuber. So, what should you do? Well, don't listen to 9 other opinions. So, find the voice that appeals to you most and do exactly what they say. Now, if you interpret that as your favorite economist from your favorite bank said, and they say, well, they're risk off. Well, you still have to do your technical analysis, bro. If they're like risk off, the markets are going to fall, you're like, okay, well, that means the dollar's going to get strong. And now you're still stuck on a 5-minute chart waiting for a bullish market to turn bearish because you don't sell in an uptrend. What? I mean, think of it. How delusional could you be to sell an uptrend, right? So you're like, dude, I can't ever sell an uptrend. Good. You have discipline. So now you're sitting there on a 5-minute chart waiting for it to turn bearish. The fact that you can sit on a 5-minute chart and wait for it to turn bearish, by definition, makes you patient and disciplined. You will be successful. Because if it never turns bearish, you never put down a losing trade. Because you're patient and disciplined. Now, you were wrong. Your guy, your economist, your favorite economist said bearish, but they're not thinking bearish every day. They're saying bearish macro, long run. Okay, so now your job is to combine long-run economics with short-run technical analysis. Easy! You're either patient or you're weak. You're either disciplined or you're weak. You should take a challenge like that and say, but Wayne, I'm strong. Awesome. You stand tall and proud and firm and strong, and you're strong enough to know you're wrong and very quickly be able to adjust. That's great. So there's no pride involved in this. Okay? So you listen to the one voice that appeals to you, and over time, pay attention. What analysis are they doing that seems to appeal to you? And over time, please do it yourself. Okay? I want you to be the voice. I want you to take care of your family. I want you to take care of your loved ones. I want you to be in control of your destiny, because the light at the end of the tunnel might be you. Not some person sitting at a bank earning a salary, because that doesn't happen in Forex, does it? So if you can't make the decision of being bull or bear, find someone else that is convincing to you to be a bull or a bear, or flip a coin. The patience and discipline will find your success. Flip a coin. Because think about it. If you went through 8 economists and they all slightly disagreed with each other to various degrees, where one thinks the exact opposite of the other and a whole bunch in the middle, well, the whole bunch in the middle doesn't give you any clarity. So now it's like politics. Now you got to pick extreme left or extreme right. Well, find the one that appeals to you. And that's good enough for now, because if you pick down and it's going up, you don't sell on the way up. Ever. 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 It's that easy. Ha 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 ha. I didn't say it was easy. I said it was that easy. And we know that ain't easy. But you know that's right. I know that you know what I just shared with you is the truth. Therefore, it's common sense. If I know that you know, then that's common sense. So logging in every day and looking for trades is going to lead to inconsistent results. You know it. You know it's true. Ooh, ooh, ooh. Huh? Girl, you know it's true. Ooh, ooh, ooh. So how do you then get consistent results? You need to trade consistently. You're a bull, you're a bear, or you're broke. Okay? So you might be in a situation today. What are you going to do today? Well, you have plan A is sort of in this zone to sell. Plan B is up here for a sell. Plan C is up here for a sell. And you have nothing else planned for the entire week. You're going to sell there, there, or there. Well, you're at A now. You don't know if it's going to go to B, and you don't know if it's going to go to C. So all you're interested in now is A, whether you take the sell, and if you get it, how do you manage your risk? Because you know if it continues going up, it can go as high as B or C. So you got to manage your risk on A. So all that matters right now is A. All right, cool. So let's organize that. I will put this here. And I will put this here. And now I'll drop into a lousy, no good, filthy, stinking 5-minute chart. The 5-minute chart is completely worthless without strategy. Well, now I have strategy. Right here, right now, those are the prices in which I intend to sell if I can confirm it using technical analysis. So I drop in here. Okay, and I look to sell. And over the next few hours, I might sell. You might have already tried. You might already be in. Cool. London open. Now we're waiting for New York open, which is now actually technically now open. Okay. And what you are planning for the day is down, up, down, up, down, up, down, up, down, up. Okay. And if you're over here, guess what? You're not interested anymore. Because plan B is up here, isn't it? So I know from looking at that 4-hour chart, we're waiting for this 21 EMA to catch up. Okay. So you are now deciding, do you engage the enemy or not? This might be end of day. This way up here would be tomorrow. So that has nothing to do with what's going on now. You're either going to sell it or you're not going to sell it. All based on rationality. Okay. And so you're probably, that would be either that happens today or it doesn't. Okay. The way I look at it is, let me do this in green. The way I look at it is, this is a lower low, and I would never buy that, ever. So the way I see this is bears have taken some profit, and they're waiting to re-enter. There are no bulls on this chart. None. Not even one. They're just a bat. What kind of bull buys a lower low? A nincompoop. He's not a bull. He's a nincompoop. So anyways, that would be like a terrible idea. So you either sell or you don't sell. What would a bull buy? A bull would probably buy something like that. A double bottom, higher high, rolled reversal. But that ain't going to happen today. That's right, Ashish, a gullible, a nincompoop. So I'll leave it to you. It's going to be a wonderful day. Oh my God. It's a beautiful day. Don't let it get away. Yeah. So, thank you for being part of the Forex.Today community. We make the Forex trading world a better place. So, no rah-rah speech about getting rich quick here. But that slap in the face was followed by a kiss on the cheek and a slap on the butt And I'm like, go get them, man. Go get them. Be strong. Be disciplined. And the quote of the day is, the light at the end of the tunnel might be you.